Hi, I'm Vaishaly and I will be discussing the case of ELMSLIE versus the Federal Commissioner of Taxation. The case surrounds many areas of law and in particular the capital gains tax, which at the time was recently introduced. Firstly, I will introduce the facts of the case, followed by the main issues and the reasoning, then the decision made by the court. I will then mention how this case has an impact on tax practitioners today. The four applicants were partners in a stockbroking business. The business commenced in 1967 by Mr. Valda as a sole trader and then became known as Valda ELMSLIE and Company when Mr. ELMSLIE became a partner. Thereafter, Mr. Moore and Mr. Moyes became partners by 1980, and in 1984, the partners had decided to form a company in the name of Valda ELMSLIE Limited to take over their business by July 1985. Following the previous meetings, in May 1985, the Hong Kong merchant bank, Jardine Fleming, through its Australian subsidiary, offered $400,000 for 50% interest in the partnership. They offered to purchase the remaining half of the business when foreign investment laws permitted to do so. In the following month of June, Valda ELMSLIE acquired $2 shelf company named Valda ELMSLIE Jardine Fleming Limited. A document was drafted in early June and a final version was signed by all partners by the 3rd of July and was dated the 28th of June, which included a comprehensive set of terms of the sale agreed by all partners. The last draft was resolved in September, however was not executed on the same day. The transaction required an approval from the Foreign Investment Review Board, and in late October, the Commonwealth Treasurer notified the company of the approval from the Foreign Investments Board regarding the transactions, and the agreements were then executed on the 6th of November. The following day, on the 7th of November, shares were officially allotted, $75,001 shares to each taxpayer and $300,001 shares to Jardine Fleming. And in July 1987, 2 years later, two of the taxpayers sold 75,000 shares for $1,275,000, and a month later, two taxpayers also sold 75,000 shares for $1,822,475. The Commissioner took the view that the capital gain derived by each taxpayer was assessable in the year of sale, which was the tax year of June 1988. The amount was calculated by deducting the cost base from the sale price for each of the taxpayers. In response to this, the applicants objected to the assessment, in which the Commissioner had disallowed. From here, the case was taken to court. As we know, the new law determining capital gains and losses was introduced on the 20th of September 1985 and was established under Part 3A of the Income Tax Assessment. The general principle establishing the application of Part 3A is stated in Section 160L, where it states that this part applies to every disposal of an asset on or after the 20th of September 1985. If a taxpayer derives a capital gain in respect to this law, then those gains must be taxed by deducting the cost base from the sale price. So the fundamental question in ELMSLIE's case really was whether the sale of shares was subject to capital gains tax. To answer this question, it is necessary to resolve whether the shares were acquired in respect to Part 3A before the 20th of September or after. Another issue that was discussed was whether the cost base reflected the true market value on allotment day. In determining when the shares were acquired, the following legislation is relevant. Section 160U, subsection 4, states the acquisition date is the date when the asset changed ownership. Section 160U, subsection 3, establishes a different rule whereby the asset was acquired under a contract. The term contract is singular, where it is assumed that the asset acquired by contract will be acquired by one contract only. It was held in the case of Chan vs. Creston that it was not enough that there was a contract that suggested the lessee would go into possession. Therefore, the contract was merely seen to be an instrument that created the operation. In the same way, in the case of ELMSLIE, the terms were set out under a contract, where the last draft was resolved on the 12th of September. However, this contract did not change the ownership of the shares. It was only after the approval from the Foreign Investment Review Board that the contract was executed, and the shares were then acquired on the 7th of November 1985. The second issue was whether the cost base reflected true market value on allotment day. The applicant stated that they were not dealing at arm's length on the acquisition of the shares on the 7th of November 1985. It is necessary to refer to section 160ZH, subsection C, which states the rule that if a taxpayer and the person from whom the taxpayer acquired the asset were not dealing with each other at arm's length, then the cost base must be in the index cost base or the reduced cost base to reflect the market value at the time of acquisition. It was held that the applicants were not dealing at arm's length value. Therefore, it was necessary for the Commissioner to consider what the true market value of the shares was on allotment day. This leads to the judgment of the case. It was held, as explained, that the shares were acquired on the 7th of November 1985. As this day was after the 20th of September, it was subject to capital gains tax, as outlined in Part 3A. It was also determined that the applicants were not dealing at arm's length on the acquisition of the shares. Hence, after calling for an expert opinion from a chartered accountant, it came to the conclusion that a parcel of 75,000 shares in VEJF was valued at $270,000 on the 7th of November 1985. This case further clarified many issues that practitioners may have to consider when dealing with the taxation of assets that may be subject to capital gains tax. Practitioners must consider several factors such as the nature of the contract. A contract that changed the ownership of an asset is the only contract that determines the acquisition of the asset, and if the acquisition was determined to be after the 20th of September 1985, then it is subject to capital gains tax. The character of the cost base used to determine the net capital gain or loss must also be considered. True market value at the time of acquisition must be determined if the parties were not dealing at arm's length at the time of acquisition. These factors, along with relevant legislation appropriate to the case, must be taken into consideration when determining the net capital gain derived from an event that is subject to capital gains tax. Thank you for listening.